Hello folks, welcome back to Trend Top. The rise of digital currencies could lead to a flood of withdrawals from high street banks, risking financial stability and the wider economy, the Bank of England has warned. Threadneedle Street said that stablecoins, a new form of digital asset usually pegged to the value of a traditional currency, would need to be regulated in the same way as payments handled by banks if they became widely available, that is. Stablecoins are similar to Bitcoin, the most prominent digital currency, but do not suffer extreme price movements because they are designed to move in lockstep with government-backed currencies. While these new forms of money can be issued by private companies, they could also be issued by a central bank, such as the Bank of England. Most UK households and businesses already use central bank money in the form of cash and private money in the form of bank deposits. The move from the bank comes as Dime, the digital currency project backed by Facebook, previously known as Libra, plans to offer a stablecoin linked to the pound. It also plans stablecoins linked to the dollar and euro, as well as a coin pegged to a basket of different currencies. Publishing a research paper assessing the impact from widespread adoption of new currencies, the bank warned that large numbers of consumers moving their deposits away from current and savings accounts and into digital assets could undermine the stability of high street banks. Setting out a scenario where a fifth of UK households and businesses move their deposits into digital money, it said this could drive up the cost for high street banks because they would lose a key source of funding. The bank said widespread use of private stablecoins could affect its ability to set interest rates, a key tool used by the central bank to manage inflation and the conditions for economic growth. It said the overall impact on lending and credit provision would probably be relatively modest, but there was a large degree of uncertainty. The bank is exploring whether to launch a central bank digital currency dubbed by the Chancellor Rishi Sunak as Bitcoin. However, it said it had not made a decision about whether to proceed, but was looking into the risks and opportunities of doing so. Bitcoin's already aging out, and the central banks may lose the race against whatever comes next. Cryptocurrencies like Bitcoin have been billed as a major disruptor to finance. But digital currencies issued by governments might be even more radical. They may even threaten the future of traditional banking. Have you noticed that more and more online businesses seem to state that they will accept Bitcoin as payment? This is cryptocurrency in action, a new generation of internet-based currencies which have grown in popularity over the last few years. You can't touch it or physically hand it over in any way, but you can use it to trade online. It's a far cry from the traditional view of banking where cash, coins, and possibly gold might be stacked in a vault just waiting to be withdrawn. But do these new cryptocurrencies represent a threat to those traditional banks? We take a keen interest in all those things technology, especially where it can impact how we build and use apps. Cryptocurrencies have already made their way into trading within fintech apps. So let's examine how it stands against those traditional banks. What are the implications for banks? A major shift has happened in how people can do businesses and make transactions. Suddenly, the value can be exchanged outside of the traditional banks in the flash of a mobile phone. As Chris Skinner, the author of Digital Bank, puts it, people who could not access trade and finance 10 years ago can do so today. This will lift many out of poverty. This is a key point. People no longer have to go cap in hand to a traditional bank if they need financing. Peer-to-peer networks, including those based on cryptocurrencies, are becoming more common, and those who might be turned away by traditional banks now have another way around financing. Are traditional banks feeling threatened by these new cryptocurrencies? In short, yeah, of course. Those who are paying attention have already identified cryptocurrencies as an industry threat. French banking giant BNP Paribas released a report where they discussed the technology behind cryptocurrency and how it could lead to making the traditional banks redundant. An analyst for the bank wrote about the software behind cryptocurrency, stating that it should be considered as an invention like the steam or combustion engine that has the potential to transform the world of finance and beyond. A UK banking report concludes that cryptocurrencies represent a threat to traditional banks, most especially if they ignore new consumer behaviors and preferences when it comes to how they transact and transfer money. The report states, Bitcoin users can handle many of their daily payment needs themselves without the need for interaction with banks and avoiding the need to incur bank fees. In the same way, the value stored in PayPal accounts moves outside the bank's payment system, depriving banks of valuable payments revenue. There are a few issues cited with these cryptocurrencies, such as their perceived haven status for possible perpetrators of illegal activities, a relatively low market cap, and a sense of volatility with the value of the currency. The traditional banks are becoming very much aware that they're ceding some ground to the new wave of cryptocurrencies. There are many people out there who absolutely couldn't wait to find a way around being beholden in some way to a big bank, and these people are taking up new options with enthusiasm. Financial authorities have long been saying, when it comes to being a stable hedge against inflation, Bitcoin and other cryptocurrencies are about as safe a bet as going to your local convenience store and buying a lottery ticket. That became doubly clear in recent weeks when China abruptly announced it was banning its banks from Bitcoin and those other transactions as well, and then the price went plummeting. If the value of a cryptocurrency can rise or fall by 30% because of a change in the stance of Chinese financial regulators or a Tesla announcement, then reliable and inflation hedge shouldn't appear in the same sentence, said Barry Eschengreen. Sure, cryptocurrencies tend to be deflationary since they're not tied to central banks that print money, and there is a lot of it being printed now to keep major economies afloat after COVID-19. Global stocks and futures have fallen as rising inflation concerns suggest the Federal Reserve and other central banks may have to raise interest rates. US consumer prices climbed in April, the greatest jump since 2009. That, on the face of it, might make cryptocurrencies seem attractive as a hedge, but there are so many other problems that make them hot potatoes as market bets. As evidenced by the shift away from the cryptocurrencies and into the gold in recent days, resulting in a nearly $1 trillion drop in cryptocurrency valuations by midweek. Just the name cryptocurrency is an indication of how dicey Bitcoin's value is. But here's the thing, cryptocurrencies aren't going away either. On the contrary, they are helping revolutionize finance altogether by threatening to eliminate traditional middlemen in transactions, whether that be private banks, lawyers, or even central banks, whatever. As a result, banks are trying to keep up, seeking to outpace cryptocurrencies with a new competitive concept, stablecoins. These are digital currencies that are like crypto coinage in some ways, but instead of being decentralized like Bitcoin, which is not overseen or regulated by governments, they are fully backed with safe and liquid assets in a domestic currency. Currently, some 80% of countries surveyed by the Bank for International Settlements are studying versions of stablecoins and what has become known as central bank digital currency, led by China and Switzerland. The success of cryptocurrencies has also spurred an eagerness worldwide to shift to digital currency. The trend has been accelerated by the COVID-19 pandemic, which has driven home the increasingly antiquated nature of cash. The problem became clear over the past year as governments failed to transfer relief money to poorer segments of the population that lacked credit cards or bank accounts. The COVID-19 crisis is a dramatic reminder of the importance of a resilient and trusted payments infrastructure that is accessible to all Americans. Brainard said last August, announcing her support for a joint study of CBDCs by the Boston Federal Reserve and MIT. All these distribution problems could be solved, Eschengreen noted, with a Federal Reserve-issued electronic wallet into which digital dollars could be deposited. The problem is worldwide. There are some countries where commercial banks put a sign on the door, "Cash not accepted here," said Tommaso Mancini Grifoli, a division chief in an International Monetary Fund's Monetary and Capital Markets Department. Final thoughts. Is traditional banking under threat from cryptocurrency? Yes and no. Most big banks are acknowledging that the technology behind cryptocurrencies should be treated as the next big thing, perhaps like the invention of the motor car to the railroad. At the same time, digital currencies have downsides like perceived volatility and some uncertainty around whether regulators will need to step in. However, banks who don't want to go the way of the early 20th century railroads, those who made the mistake of failing to see the motor car as a threat, would be wise to pay attention to consumer preferences. Getting on board with digital trends may help to mitigate the cryptocurrency threat. This is all for today, folks. If you enjoyed the video, then leave a like, and if you are new, then do not forget to subscribe. See you till the next video, and thank you for watching.